Hello and welcome to the latest Structured Finance in Focus podcast. My name's Ben McCarthy. I'm a managing director and head of the Asia Pacific Structured Finance and Covered Bond analytical team. Today I'm joined by Kevin Kendra, who's managing director and head of North American RMBS, and Alessandro Pighi, who is managing director and head of European RMBS. Welcome back to our annual discussion. On this episode, we're going to be discussing our recently published Global Housing and Mortgage Outlook report. The report includes house price forecasts and expectations for mortgage performance across 13 different countries for the coming year. And it's always highly anticipated and puts housing metrics side by side of the most active countries in our global RMBS portfolio. So we might get straight into it and start with house prices. Maybe, Kevin, you can start with the outlook for North America.
Sure. So for the U.S., we see, generally speaking, house prices are really going to be flat, but we do have regional differences, right? So if we take a look across the country, we're seeing a little bit of softness in the South and out in the West, but the Northeast and the Midwest are actually holding up a little bit better and a little stronger. And so nationally, we think that house prices could go anywhere from -2 to +2, depending on the dynamic that actually transpires between the various regions. But we're really still seeing the infill on the Northeast holding fairly flat. And really what's happening is it's bringing our sustainable home price closer to where real home prices are. So when we think about home prices for the U.S., we see we've been in an overvaluation state for the last 3 to 4 years, really since the pandemic. But really see that starting to lighten up a little bit. And there are a couple of things that we'll talk about later in the podcast that are things to look for that could shift things either negative or positive.
Okay, Alec, do you want to cover Europe?
Yeah, sure. As Kevin was saying, there's a bit of differences in Europe as well. So starting with the Eurozone, we have very strong growth in Iberia, specifically in Spain, which is covered in the report. So very strong single-digit growth that we expect in 26. Then we have Netherlands, that is 4 to 6%, the range of growth for 26. Netherlands has had a very strong 2025 in terms of appreciation, with a correction in 23 and the first part of 24. So it's effectively recovering from that dip due to mortgage rate refixing at higher level. And then we have Germany that is also recovering from past underperformance. We forecast 2 to 4% for Germany, and then we have Italy that is lagging a little bit behind versus other EU countries, but still positive outlook in terms of past experience. So we forecast around 2% of growth. For the UK, we have a 2 to 4 house price appreciation, but I'll talk about the UK a bit further, maybe in the next sections of this podcast. There is a bit of an outlier there. Sorry, coming back to the EU, I forgot the France, which is the country where we expect flat growth effectively. France has seen 2 years of depreciation due to macroeconomic uncertainty and fairly soft demand on mortgage.
For Asia Pacific, there's 3 countries included in this report, which is China, Japan, and Australia. It's a bit of deja vu of more of the same in that our forecasts are very similar to what they were last year, although they're very different from each other. So, in China, house prices are likely to decline further in 2026. House prices are already 20% off their peak in 2021, and we're forecasting them to fall another 4 to 6% in 2026. So, being the sort of the 5th year in a row of house prices falling, it's basically off the back of a weak economy. And the weak economy partly driven by the weak property market. And so the government's policy supports for home sales haven't really gained traction as yet. And we're expecting that to continue into next year. There is a differentiation between the tiers of cities, so that the tier 1 cities, which are the sort of major 4 cities, are going to perform better than the smaller cities, which is again, similar to what's happened this year. For Australia, sort of in contrast, following on from a very strong price growth in 2025, which was sort of got to, it'll finish the year around 8.5% in terms of growth to this year. Going into next year, we're forecasting, the house prices to continue to rise 3 to 5%, despite the sort of decreasing affordability that's coming through. Lower interest rates, we've still got, lower immigration, but it continues, and limited property supply growth to match household formation needs means house prices will continue to rise. In Japan, like a similar story to what Australia is in terms of just the tight supply, and higher incomes are supporting house price growth of between 3 and 5% for 2026. If we just move on to sort of mortgage performance, Kevin, do you want to cover what's likely to happen for North America?
Sure. So first, we should say that performance is well within our expectations. When we look at our forecast for 2026, it's a slight increase of 1.6 to 1.8% increase for arrears. But what we're really seeing is it's the 2023 vintage securitizations that are seeing pockets of underperformance. So these were mortgages that were originated in the second half of 2022 when interest rates were rising in the U.S. and the credit boxes were, originators were opening the credit box a little bit, and then we're seeing that in the performance now. They quickly closed the credit box in 2023, so what we're seeing now is the 2024 and 2025 vintages are well within our expectations. So I think that we'll see a small increase in our forecast for arrears, but nothing that's outside of what we're expecting.
Sorry, Alessandro, Europe?
Yes, same story. So really, it's stability of performance. We forecast the arrears, late arrears, we track in the report to be broadly stable across EU and the UK. There's some very small uptick in arrears where we're talking about second decimals, so really like something that is immaterial. The UK merits maybe a couple of words. So the core production of mortgages is well under control in terms of performance. But the UK is probably the only country in Europe where there is a substantial specialist lending sector. And there we see a bit more deterioration in arrears, but still well within our expectations. One interesting trends on mortgage rates, we have France, Germany, and Netherlands are long fixed rate products, where effectively the mortgage rates are expected to slightly increase if we look at the forward curves for swap rates of 10, 20 years tenure. For Italy and Spain, the reverse is happening because ultimately these swap rates are really in relation to the treasury, and the Italian and Spanish government bonds are tightening versus the rest of the Eurozone. So there's a different trend that is worth highlighting. Mortgage rates we expect to decrease in Spain and Italy and increase in France, Germany, and Netherlands.
Okay, and for Asia Pacific, our the forecast on mortgage performance largely mirrors the house price forecast, in that China's deteriorating slightly. The economic softness that's happening there and employment volatility would contribute to a moderate deterioration in late stage arrears in China. I will point out that the problems in the property market there have resulted in no RMBS being issued the past 4 years. So, when we're looking at performance of RMBS portfolios, we're looking at portfolios that are well seasoned and that are getting very much smaller than they were. So we're sort of looking at the tail end in terms of performance. But general mortgages in China, we're expecting a very sort of minor deterioration. In Japan and Australia, both we're seeing very stable performance next year. Australia late stage arrears expected to not really move, sort of still between sort of 0.5 and 0.6%, supported by low interest rates, low unemployment, and a robust economy. So, I think for Japan, again, very similar conditions to this year, stable employment, and the risks hinge on the pace of tightening by the Bank of Japan. and the real wage dynamics in that market. But generally across all three, I'd say, very stable performance. And we might finish off with a quick question on things people should look out for. So, Kevin, what should people be looking at for the US in 2026?
Well, similar theme that we've talked about in years past, where from a housing market perspective, we're still fundamentally undersupplied in the US. That's driving affordability issues. So, what the things that I would focus on are, how is the political environment and the invisible hand of government going to play into the mortgage markets coming forward? So we know that there's a Road to Housing Act already passed through the Senate. We know that the House of Representatives are looking at forming their own act to actually look to pass. So as we move into a mid-year election cycle in 2026, we're expecting to see housing and affordability of housing be a front and center topic for both parties. And so we think that there's going to be some action one way or the other. And so it's really how is the hand of government going to actually influence the housing market? If they address it with bringing on more supply, we think that that's a good balance. But if they're only addressing kind of affordability by looking at financing, that could have an adverse effect on driving prices up higher, because you're really not impacting the supply demand dynamics. Lastly, what I would say is the market's really expecting a drop in mortgage rates in 2026. And so that we would expect to see a lot more refinance volume. So from the mortgage originations that we saw for the last couple of years, we would expect to see a drop in interest rates would drive refinancings, which would then drive more securitization volume. So while we've gone back-to-back years of record RMBS issuance, we see that growth actually continuing, because there is going to be a significant amount of refinancing that actually comes through the pike in the near future.
Okay, thanks. Alan, what's the story for you?
Yeah, risk to watch. I would say the undersupply themes is also a common thing for Europe. So absent a kind of a shock to labor market or macro shock, we don't foresee house pricing effectively decreasing. What can just change is a combination of political uncertainty, both at national level and internationally, coupled with effectively maybe a shock to the labor market. So we foresee, for instance, for the UK, a 0.5% increase in unemployment in 2026, with a very mild reduction in 27. So all in, if you look at 24 versus 27, we're 1% higher in terms of unemployment rate. For France, same topic, but with a smaller gap, 0.3% increase in unemployment rate. So all in all, these are not figures that would just drastically change our views, but there are signals that the markets are fairly soft, and the macro environment is not particularly benign anymore. And so political uncertainty is what I would watch as a potential kind of root cause for deterioration in housing markets.
And for Asia Pacific, things to watch, I would encourage people to take a look at the report. It covers a lot more detail than what we've been able to cover here. But for the countries covered in APAC, the key watch points are the mortgage rate trajectory in Japan, migration and housing approvals in Australia, which are things that are likely to change, and as Ali mentioned, issues around migration and sort of the interaction with government policy is an issue in all of these markets, and particularly in Japan, that sort of the policy efficacy and the pace of inventory clearance is going to be key to what happens in that market. I think we might leave it there. So thanks, Kevin and Ali, for your participation today and for your insights. And thank you all for listening. For more information on the topic, please visit our website at fitchratings.com.